Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I have two paper money trades for you today on two high-profile names. We'll look at Apple and we'll look at Boeing, two large cap names that we're going to look at today. First, let's get right to it with Apple. Now, if you look at Apple in the last 3 months, down 13.25%. Last month, down 9.25%. So what we're looking at here on a move on Apple from as high as $260 down to where it is now, $215. So the paper money trade we're looking at here is taking advantage of higher levels of implied volatility, taking advantage of what the expected move is from now out till the March 28th, so just 15 days. We have that expected move around $13, and we're going to be a little bit inside that. We're going to look at the short put vertical in Apple. We're going to sell the March 28th 205-200 put vertical. So about $10 below where the stock is trading right now. So if you know, a high probability put vertical can be profitable in 3 of the 4 instances. An upside, right? A unchanged, a downside that's less than $10 down to the 205 strike, where it's risk, a break through 205 and towards $200. Now, the current credit we have for this spread, we put it at $90. It's trading right, or 90 cents. It's trading right at 90 cents. So now, the risk is different on a short put vertical, right? The risk on this trade is the width of the strikes, $5, minus whatever credits you take in. So if it's $5, 90 cents, the risk on this trade is $410. One thing we focus on when we look at these is the probability of out of the money. For the 205 put, the probability at expiration that it will be out of the money, 73% chance that it will be out of the money. So that's what we call a high probability trade. Doesn't guarantee you're going to be successful, but the probabilities are in your favor. Okay, so remember, the risk on the trade, the width of the strikes, minus whatever the credit that you take in is. So in this case, $5 minus 90 cents, $410 risk in Apple. All right, let's get to our second trade of the day, and that is Boeing. They were upgraded today at Citigroup. Remember, and this is another trade that 1 month down 13.5%, 3 months only down 1.8%. So this has been a 1 month sell-off here in Boeing. So let's look at the paper money trade. We went to the April 4th expiration, so we gave ourselves a little bit of time, 22 days till expiration, and we put on a call diagonal, buying the 160 strike, so right at the money, and selling next week's March 21st, 167.5. Now the move in this case is about $9.50. We're going about $7.50, actually right around $7 higher. So almost daring the stock to go higher. But that gives us, remember, the lower the strike you sell, more premium you're taking in, lowers the net debit. The debit on this trade, we put it in around $5. It's trading around $5.37 as Boeing has rallied slightly in the last several minutes. So $5.37, we put it in at $5. Whatever the debit paid on a diagonal is the risk on the trade. Now, one thing about this is buying the April 4th, selling March 21st, does give you a chance to extend duration into that March 28th expiration. So you do get a chance to chip away at the net debit, which also chips away at the break-even price. But the risk on this trade, whatever the debit paid is, if it's 5, is it closer to 5.35 or 40? That's the risk on this trade. And you're looking for a move up towards the short strike of 167.5 by next Friday. Remember, this is a March 21st expiration there. So those are our two trades today, a short put vertical in Apple and a long call diagonal in Boeing. That's our show for today, everyone. We'll see you tomorrow with another edition of the Daily Trader. I'm Kevin Hincks.